Well, I've been doing this for a long time now, longer than I sometimes care to admit. And I've seen bubbles come and go, seen fortunes made and fortunes lost. But this one we're in right now, this AI bubble, it reminds me of something I thought we'd learn from. See, back in the late 90 seconds, I remember sitting in my office in Redmond watching the world go crazy over anything with a dot at the end of its name. Companies with no earnings, no business model, no real reason to exist beyond a flashy website. They were being valued in the billions. And I stayed cautious about it. People called me old-fashioned, said I didn't understand technology. That's the funny thing about being old-fashioned sometimes. It just means you remember what happened last time. Now I'm in my 70 seconds, and here we are again, except this time it might be worse. And I don't say that lightly. You see, when people ask me about artificial intelligence, about these AI companies that are being valued like they've already conquered the world, I tell them what I've always said. You got to understand what you're buying. And more importantly, you got to understand what everyone else is buying, because there's a difference, between a good technology and a good investment, a real big difference. Let me take you back for a moment, back to the year 2000. The dot-com bubble had just burst. Companies that were worth hundreds of millions, some even billions, they went to zero. Poof, just like that. I remember reading about these CEOs who went from being on magazine covers to being forgotten. And the thing is, the internet was revolutionary. It did change the world, but that didn't mean every internet company was worth investing in. In fact, most of them weren't worth a dime. That's what people forget. You see, they confuse a revolutionary technology with a revolutionary investment opportunity. And that confusion, well, that's where fortunes disappear. Now I look at what's happening with AI today, and I see the same pattern, the same fever, the same irrational exuberance that Alan Greenspan talked about back then, except this time the numbers are bigger, much bigger. Paul and I, Paul's not with us anymore and I miss him every day, but Paul and I, we used to talk about this, about how markets go through these cycles, these moments of collective madness where everyone forgets the basic rules. And the basic rule is simple. A business is worth the cash it's going to generate over its lifetime discounted back to today. That's it. Doesn't matter how exciting the story is. Doesn't matter how many articles are written about it. Doesn't matter if everyone at the cocktail party is talking about it. What matters is cash flow, real tangible cash flow. So when I look at these AI companies today, companies valued at 50 billion, 100 billion, some even more, and I ask myself, where's the cash flow? Where's the profit? And more importantly, where's the moat? See, I've always talked about moats, economic moats, the kind of competitive advantage that protects a business like a castle. Moat protects a castle. And the thing about AI right now is I don't see many moats being built. I see a lot of castles, but not many moats. You know what I see instead? I see a race to spend the most money to build the biggest models to promise the most revolutionary future. And in a race like that, everybody runs fast, but not everybody finishes. And some folks run right off a cliff. Let me tell you something about investing that I learned a long time ago, back when I was buying my first stocks as a kid. I learned it from Ben Graham, my teacher. He said, price is what you pay, value is what you get. Simple, right? But people forget it, especially when everyone around them is making money. When your neighbor's getting rich on some AI stock, when the guy at the barbershop is giving you stock tips, that's when it's hardest to remember that simple truth. Price is what you pay, value is what you get. And right now, the prices don't match the value, not even close. I'll give you an example. There are companies out there, AI companies, that haven't made a single dollar in profit, not $1, and they're valued higher than companies that have been making billions in profit for decades. How does that make sense? Well, it doesn't. Unless you believe in magic, and I don't believe in magic, never have. I believe in numbers, in cash flow, in businesses that make something people need and can charge more for it than it costs to make. That's capitalism, that's value creation. But what I'm seeing now, it's not value creation, it's value speculation. It's people buying a story, not a business. Now, don't get me wrong, AI is real, it's powerful, it's going to change things, probably already has in ways we don't fully understand yet. But here's the thing, just because something is going to change the world doesn't mean you should buy stock in every company working on it. You know, the automobile changed the world, changed everything, but there were thousands of car companies in the early 1900s. And how many survived? 3, 4. The technology was revolutionary. The investment opportunity, not so much. Most people lost their shirts. The airplane, same story. Revolutionized travel, changed the world. But if you'd invested in airline companies over the decades, you'd have been better off, quite frankly, if the Wright brothers had never gotten off the ground. I've said that before, and it's still true. See, these transformative technologies, they're wonderful for society, but they don't always make good investments because the benefits get spread around, competition drives down prices, costs stay high. And the profits, well, the profits go to whoever has the best business model and the strongest competitive position. And right now in AI, I don't think anyone really knows who that's going to be. There's a lot of guessing, a lot of hoping, but not much knowing. That's what worries me. Not the technology. The technology is fascinating. What worries me is the certitude, the confidence. Everyone's so sure that their pick is going to be the winner. But history teaches us that most people are going to be wrong. You know, I remember in the dot-com days, people would tell me about network effects and first mover advantage and all these fancy terms. And sure, some of that was real. Amazon had network effects. Google had network effects. But for every Amazon, there were 100 pets.com and Webvan and companies whose names I can't even remember anymore. The problem is, at the time, they all looked promising. They all had smart people running them. They all had venture capital money pouring in. But most of them didn't survive because hype doesn't pay the bills. Cash flow pays the bills. And I look at today's AI landscape and I see the same thing. Lots of hype, lots of money pouring in, lots of promises, but not a lot of profit. Not yet. Anyway. Now, some people might say, Bill, you're too old to understand this. This time is different. And you know what? Maybe they're right. Maybe I am too old, but I've been told this time is different about 5 or 6 times in my career. And it's never been different, not really. The fundamentals don't change. Human nature doesn't change. Greed and fear, they don't change. And bubbles, well, bubbles always pop eventually. Always. The only question is when. And who's going to be left holding the bag when they do? Let me tell you what I've noticed. And this is just from watching and reading and thinking, which is most of what I do these days. Anyway, the amount of money being spent on AI infrastructure right now is staggering. I mean, really staggering. We're talking hundreds of billions of dollars going into data centers, chips, training models, computing power. And here's the thing, all that spending, someone's got to pay for it eventually. Someone's got to generate enough revenue to cover all those costs and make a return on that investment. And I'm not sure the revenue's there, not yet. Maybe not for a long time. It's like building a massive factory before, you know, if anyone's going to buy your product, or building a gold mine before you know if there's gold in the ground. You're spending real money now, betting on uncertain returns later. That can work out. Sometimes it does. But sometimes you just end up with a very expensive factory that sits empty, or a very deep hole in the ground with nothing in it. And the AI companies, they know this. They have to know this. But they're caught in a trap. You see, if they don't spend billions keeping up with their competitors, they fall behind. But if they do spend billions, well, there's no guarantee they'll ever make it back. It's a prisoner's dilemma. That's what Paul would have called it. Everyone would be better off if they all spent less. But nobody wants to be the first one to slow down. So they all keep spending and spending and spending. And who pays for all this spending? Well, the investors do, the people buying the stock. They're the ones funding this race. And they're doing it because they really believe that their company is going to be the one that wins, the one that figures it out, the one that becomes the next Google or Amazon. But here's what I know from experience. Most of them won't be, can't be. Simple math. If there are 20 companies in a race, 19 of them are going to lose. Maybe all 20 will lose. That's how races work. And the thing about losing in a race like this, when you've spent $50 billion getting to the finish line and you come in second or third or 10th, you don't get a consolation prize. You just get a very large bill and some very angry shareholders. Now, I've been thinking about this a lot lately, about why bubbles form, why smart people, and these are smart people, make no mistake, why they get caught up in them. And I think it comes down to something pretty simple. Fear of missing out. You see someone else making money. Your college roommate bought some AI stock 6 months ago and it's up 300%. And you think, well, I should get in on that too. And then more people think that, and pretty soon everyone's buying not because of the fundamentals, but because the price is going up. And when I look at the incentives in AI right now, I see a lot of people getting rich, not from building sustainable businesses, but from building hype. CEOs getting paid in stock options that vest based on hitting market cap targets. Venture capitalists raising bigger and bigger funds. Investment bankers collecting fees on every financing round. Everybody's making money as long as the bubble keeps inflating. Nobody wants to be the one to say, hey, maybe we should slow down. Maybe these prices don't make sense. Because saying that, well, that's bad for business, at least in the short term. Better to keep the party going, keep the music playing, and hope you can find a chair when the music stops. But here's what I know. The music always stops, always. And when it does, a lot of people are going to be left standing. You know, I think about the dot-com bubble a lot these days because the parallels are, they're striking, really striking. Back then, people would say the internet is going to change everything. And they were right, it did change everything. But that didn't mean pets.com was a good investment at $1 billion valuation. It didn't mean that every company with a website was going to succeed. The technology was real, but most of the business models weren't. And I see the same thing now with AI. The technology is real, the potential is real, but a lot of these business models, I'm not so sure about them. I'm not sure how they make money. I'm not sure how they compete. I'm not sure what their moat is. And if you don't have a moat, if you don't have something that protects you from competition, then it doesn't matter how good your product is. Eventually, someone else is going to come along and do it cheaper or better or both. That's capitalism. It's creative destruction, and it's wonderful for consumers, but it's tough for investors if you pick the wrong horse. Now, some of these AI companies, they'll survive. Some of them might even thrive. But figuring out which ones, that's the hard part. That's always the hard part. And when you don't know which ones are going to win, when the future is that uncertain, then you shouldn't be paying premium prices. You should be paying bargain prices because you're taking on a lot of risk. But that's not what's happening. People are paying premium prices for maximum uncertainty, and that's not how you make money in the long run. That's how you lose it. I remember a story might have been from the 1,920 seconds before the big crash. There was this shoe shine boy who gave stock tips to one of the wealthy businessmen. And the businessman thought, if even the shoe shine boy is playing the market, it's time to get out. And you know what? He was right. When everybody's sure they're going to get rich, that's usually when the top is near. And I look around today and I see AI everywhere. Every company is an AI company now. Every product has AI powered in the description. Everybody's talking about it. Everybody's investing in it. And that makes me nervous, real nervous, because the best investments, they're usually not the ones everyone's talking about. They're the ones that people have overlooked or misunderstood. The ones trading at a discount, but there's no discount here, no margin of safety. It's all priced for perfection. And perfection, well, perfection is hard to achieve, especially when everyone's trying to achieve it at the same time. You know, what else worries me? The amount of debt being taken on, companies borrowing billions to fund AI development, to build infrastructure, to compete. And debt is a dangerous thing. It amplifies everything. If things go well, you do great. But if things go poorly, debt can kill you, can wipe you out completely. I've always been conservative about debt, always. Paul and I, we kept Microsoft with very little debt because we wanted to survive. We wanted to be around for the long term. And you can't do that if you're leveraged to the hilt. But these companies, they're making bets, big bets with borrowed money. And maybe those bets will pay off. Maybe AI revenue will come in fast enough and big enough to cover all those costs and service all that debt, but maybe it won't. Maybe it'll take longer than people think. Maybe the revenue won't be as big as expected, and then you've got companies with massive debt loads and not enough cash flow to cover them. That's how companies go bankrupt. That's how investors lose everything. Not because the technology was bad, but because the business model couldn't support the debt. Let me tell you something else I've learned, something that took me a long time to fully understand. The stock market is not the economy, and the economy is not the stock market. What I mean is, just because AI is going to create a lot of economic value doesn't mean AI stocks are going to create a lot of value for shareholders. Those are two different things. The economic value might get captured by customers through lower prices, or by employees through higher wages, or by suppliers, or by society in general. It doesn't all flow to shareholders. And in highly competitive industries, which AI is looking more and more like every day, a lot of that value gets competed away. Companies spend billions developing products and then have to price them low to compete. And the profits, well, the profits never materialize. I've seen this before, seen industries where everyone invested huge amounts, created tremendous value for society, and nobody made any money. Airlines, automobiles, telecommunications, steel, railroads in the early days, all transformative, all revolutionary, all terrible for investors, at least for most investors. And I think AI might be headed down that same path. Lots of value created, not much captured by shareholders, at least not by most shareholders. Now, there will be winners. There always are. There will be companies that figure out the right business model, that build real moats, that generate strong returns. But here's the thing. You don't know which ones they're going to be. I don't know. Nobody knows. Not really. Not with any certainty. And when you don't know, when you're that uncertain, you shouldn't be betting big. You shouldn't be putting a large percentage of your money into something that could easily go to zero. That's not investing. That's speculation. And speculation is fine if you know what you're doing and you're only risking money you can afford to lose. But most people, they're risking more than they can afford. They're risking their retirement, their kids' college fund, their future. And that's what keeps me up at night, not the bubble itself. Bubbles happen, but the people who are going to get hurt when it pops, you know, after the .com crash, I heard so many stories of people who'd lost everything, people who'd quit their jobs to day trade, people who'd borrowed against their houses to buy tech stocks, people who thought they'd found the secret to easy money. And when it all came crashing down, their lives were ruined. Not exaggerating, really ruined. Marriages ended, retirements disappeared, dreams vanished. And the sad thing is it didn't have to be that way. If they just been a little more cautious, a little more skeptical, a little more focused on value instead of hype. But that's hard to do when everyone around you is making money. When you feel like you're being left behind, the fear of missing out, it's a powerful thing, powerful and dangerous. I've been fortunate in my life, very fortunate. I got to do what I loved every day, work with people I admired, build something lasting. And as I've said recently, AI is the biggest technical thing ever in my lifetime. Its influence is hard to overstate, and it's profound. But absolutely, there are a ton of these investments that will be dead ends. If you want to be a tech company, you don't get to say, no, let's check out of this race. It's not like tulip mania. But it mirrors the dot-com era's hype and overvaluations with real-world challenges like energy demands and job displacement risks. Let me expand on that a bit because it's important. Back in the 1,630 seconds, there was this thing called tulip mania in the Netherlands. People were going crazy over tulip bulbs, bidding them up to insane prices, like more than a house sometimes. And then it all crashed because, well, they were just tulips, nothing more. No real value beyond the flower. But AI is different. It's so profound, it could give us personalized medical advice, tutors for every kid tailored to their needs, accelerate drug design to cure diseases we've been fighting for decades. That's real economic value. That's why I say this bubble isn't tulip mania. It's more like the early internet days. The frenzy is there, the overcommitments are there, like building data centers that guzzle electricity at rates we haven't planned for. We're talking about energy demands that could strain power grids worldwide if we're not careful. I've seen estimates that AI could consume as much electricity as entire countries by the end of this decade. And if those investments in massive computing power don't pay off because the models become obsolete or the revenue doesn't materialize, well, that's a dead end, a very expensive one. And then there's the job side of things. AI is going to displace jobs, no doubt about it. Knowledge workers, manual labor, eventually with robots, it's disruptive. But it could also create new opportunities, just like the internet did. The problem in a bubble is we overhype the positives and ignore the risks, leading people to make bad bets. Look at recent studies, like one from MIT just a few months ago. They found that 95% of organizations see zero return on their AI investments. Billions spent 30 to 40 billion on generative AI alone, and only 5% are getting real value. Most pilots fizzle out because the tools don't integrate well, they lack context, or they just boost individual productivity without moving the needle on the business. That's classic bubble territory, Me Too, companies copying each other, burning through cash, no real moat. In the dot-com days, we had the same overvalued startups that looked innovative but were just riding the wave. Some succeeded, like us at Microsoft, because we focused on fundamentals, but many were just hype. Today, with AI, the CapEx is even bigger. Trillions planned, tech stocks making up over half the market, bigger than dot-com peaks. And governments are backing it, CEOs are all in, creating this feedback loop of buzz and capital. But doubt it at your peril, pullbacks will come, and the cries of "it's over" will echo, just like before. Yet the market can stay irrational longer than you think. AI's reach is global, deeper than the internet was back then. Every headline fuels more investment, but without profits, without ROI, it's unsustainable. We've got companies like NVIDIA rocketing on chip demand, OpenAI raising billions. But how many are truly differentiated? How many are just Me Too entities that will fall behind? The shakeout will be major. Tech is a whole new world now, but the patterns are the same. Multiple compression won't crash it alone. But when the hype fades and reality sets in, energy costs skyrocketing, jobs shifting, revenues lagging, that's when the bubble pops. And this one, it's bigger than .com, 17 times in some measures, 4 times the subprime mess. When it bursts, it'll ripple through the economy, maybe even cause a crisis. Billionaires might scoop up assets on the cheap, but regular folks, they'll suffer. Capitalism can feel like a scam in those moments. So that's my message to you today. My warning, my advice, take it or leave it. I'm just a guy from Seattle who's seen this movie before, who knows how it ends. And I'm hoping, really hoping, that this time more people will listen, more people will be careful, more people will protect themselves, because the AI bubble, it's worse than you think, bigger than the .com bubble, more dangerous. And when it pops, and it will pop, a lot of people are going to get hurt. Don't be one of them. Please, be smart, be careful, be patient. Watch this video, share it with friends, and think twice before jumping into AI stocks. Focus on real value instead.